What sticks out to you as being the most significant development so far?
I think you've got to look at a couple of things. I think you've got to look at what the Fed's done, shifting its rhetoric from a tightening policy to a more patient policy. I think that's had a big impact on markets. And as you know, trade has obviously got to be front of mind. And I feel that as we've gone through the course of this year, it does feel like the mood music around it is getting better. Obviously, the meetings over in China this week, it now sounds like we're going to be back in Washington next week. It feels like both the US and China want to come to some form of agreement. So I think the combination of those two have actually led to the performance we've seen in markets so far this year.
Ian, we got weaker than expected economic data out of Germany. The Eurozone isn't exactly growing quickly. There are signs of a slowdown here in the U.S. The retail sales number yesterday was pretty dismal. Does that mean that we are on the verge of a global contraction or recession anytime soon?
I would phrase it more as a global slowdown. We've obviously seen some weaker data out of China. We've seen some weaker data out of Europe. Now, if we do get some of the big stimulus that's coming through at the moment from China, and as that filters through the system over the next couple of quarters, that should support the Chinese economy. And actually what it will do is it will be a knock-on effect to Europe, who is obviously very supportive of global trade. But I think you have to be aware that, as you said, the data out of the US yesterday, okay, maybe there's some question marks around that, but let's see the next couple of prints. But it looks like we're going to slow down. That said, I do feel that what's happened on the central bank front, especially with the Fed taking its foot off the gas on the tightening side, probably means that the cycle will get extended and we have a slowdown and not an actual contraction.
All right, so slowdown but not contraction. That still begs to me government debt around the world, sovereign debt for developed economies. That seems to be the play. But is that the right way to go about doing that? You manage a bond fund, so how do you position yourselves given the idea that it's a contraction, not a contraction, a slowdown, not a recession?
I think within the fixed income markets, you probably want to look at a couple of things. You probably do want to own some duration. Maybe that wasn't the case this time last year as the Fed was raising rates, but if they are on pause, having government bonds, having 10-year treasuries at 265, 270, that probably makes sense. Though I would avoid areas like Germany, which sub 10 basis points on the government side. But actually, if you're not having a contraction, just a slowdown, and you're not going to see a default cycle, then that actually means that parts of the credit market, whether it's high yield, whether it's investment grade, can be supported. And then again, think about the Fed. If it's pausing, maybe the dollar doesn't strengthen so much. That should support emerging markets. So I think there's a lot to be done in fixed income. What I would take from that is you want to be diversified and be agile and be flexible to navigate these markets.